Welcome to the Deep Dive. We've gone through the earnings transcripts, the analyst notes, all of it. And our mission is simple: to cut through the noise and give you the insights that actually matter. Today, we're jumping into Ball Corporation's third quarter 2025 performance. This call was a big one. It wasn't just about the financials.
Not at all. It was really the proof point for their whole new strategy.
Exactly. That intense focus on the global beverage can business now that they've shed all those other assets. So we're going to break down three things. The core financials, which were, pretty resilient. The commentary around some margin pressures. And then the big one, the forward-looking strategy that all seems to hinge on what happens in 2027.
Let's get right into it. The market's reaction was what I'd call a measured beat.
Not euphoric, but solid.
Perfectly put. It shows the underlying business is strong, even with all the macro noise. So, headline numbers. Third quarter revenue hit $3.38 billion.
And that was a beat, right?
A clear beat, yeah. Consensus was looking for about $3.32 billion, so that's, 9.6% year-over-year growth. Pretty robust.
Okay, so the top line looks great. What about the bottom line, the earnings?
The bottom line was a meet. The comparable, or, the non-GAAP EPS landed right on the money at a $1 or $2.
I did see the GAAP number was higher at $1.18.
Right, and that's mostly just accounting noise from all the big sales and restructuring. Management basically asks you to look past that to see how the core operations are actually doing.
Makes sense. But for me, the real story was the volume.
Oh, absolutely. The signal of real health. Global aluminum packaging shipments, they grew 3.9% year over year.
And the beverage cans specifically.
Even better, total beverage can volumes were up 4.2%. So demand is clearly not the issue here.
And that strength was sort of reflected in the stock, which ended the day up about 1.5%. But the trading activity underneath, that was fascinating.
It really was. The volume was huge, almost 5 million shares compared to a 3 million average.
And the options desk were flagging all this unusual action. It tells me the smart money was definitely making moves.
For sure. But the fact that the stock didn't surge suggests investors are looking past today's numbers and are focused on the future.
The future leverage.
Exactly. And to get that, you have to understand the huge strategic shift that they have just completed. This is all happening after they sold the aerospace division last year.
And they kept cleaning house this year.
They did. They deconsolidated the aluminum cups business in March, basically got that distraction off the books. Then in August, they trimmed their stake in a Saudi JV down to just 10%.
So the message is crystal clear. Ball Corporation is now a global beverage can company. Period. That's the only game in town.
And that focus is translating directly into capital returns. They are being incredibly disciplined. Year to date, they've already returned $1.27 billion to shareholders.
Wow. Between buybacks and dividends.
Yep. And they're on pace to meet or even beat $1.5 billion for the full year. That's a huge number, and it's coming directly from this new, simpler structure.
Okay, so they're returning a lot of cash. But where is it all coming from? Let's break down the actual segments. We should look at comparable operating earnings, the COE.
Right. That's the number that strips out all the one-time stuff and just shows you how the plants are running.
Let's start with North and Central America, NCA.
Yeah.
COE there was up 3.5%.
And volume was strong, mid-single-digit growth, and it was really fueled by the non-alcoholic drinks.
They specifically called out energy drinks, which just keep exploding.
That category loves aluminum cans. Now, let's go over to EMEA, that's Europe, Middle East, and Africa. They saw incredible leverage there.
The COE number was huge.
It was, up 14.8%. Volume growth was also strong, mid-single digits again. I think that's driven by good consumer demand, but also that ongoing regulatory push away from plastic.
Right, the sustainability angle. That trend seems to have legs.
Very durable. And then rounding it out, South America, COE up 2.6%, also with mid-single digit volume. Argentina was a bright spot there.
But I remember they mentioned some softness in Brazil.
Yeah, a little bit, but they said it was just weather-related, and they expect it to bounce right back in the fourth quarter.
Okay, now this is where the conversation gets a little more complex and where I think investors really need to pay attention. The mix headwind in North America.
Yes. This is the big nuance in the quarter. So despite that strong volume growth we just talked about, the operating leverage,
the profit they make on each extra can.
right, it was lower than it's been historically.
So the plants are churning out more cans, but the profits aren't growing as fast as you'd expect. Why is that?
It's all about the product mix. Demand is shifting hard toward lower margin products, specifically multi-packs and those smaller 7 and 12-ounce cans.
The ones the big soda companies are using.
Exactly. They're using them to hit certain price points for consumers that feel more affordable right now.
Now, management called this a deliberate choice, which, can sometimes sound like corporate spin. A margin hit is a margin hit.
It's a fair question. Their argument is that it's strategic. They're choosing to supply the brands that are winning long-term, the energy drinks, the seltzers, the craft stuff.
So they're taking a short-term margin hit to lock in long-term market share.
That's the bet. They believe it secures their position for the next decade, but it is a risk if this trend keeps going without some major cost savings down the line.
That makes sense. It's a long game.
Yeah.
Okay, so let's shift to guidance and the macro picture.
Right. So they reaffirmed their full-year guidance, still targeting 12 to 15% comparable EPS growth for fiscal 25. They seem very confident that demand is holding up.
But if the revenue beat was strong and they confirmed guidance, why was the stock reaction so, muted? Just up a little bit.
It all comes down to expectations. The implied EPS range for the full year, about $3.55 to $3.65, was pretty much right where the street already was, maybe even a hair below the most bullish analysts.
So it confirmed the story, but it didn't really elevate it.
Exactly. No new surprise to the upside. And in terms of physical demand, the outlook is still really good. Global volume growth for 25 is expected to land above their long-term range.
Okay, what about the external risks? Like the Section 232 tariffs on aluminum.
Yeah, they gave a really important clarification there. They said those risks are totally manageable because they have pass-through contracts with their customers.
So Ball doesn't eat that cost.
Nope. They said they pass through a price increase of about 25 to 30% tied to those tariffs, which sounds like a lot. But they said on a per-can basis, it's negligible for the customer.
Interesting.
And they added a really subtle point. If those tariffs were ever reversed, it would just be a healthy cost reduction for their customers, which could even boost demand further.
Okay, now this is where it gets really interesting for me. The look into 2026 and 2027, this feels like the entire long-term story right now.
It absolutely is. Management said their current contractual outlook is the strongest they've seen in 15 years.
15 years. That is a massive statement. That kind of visibility is a huge advantage.
A huge advantage. But it immediately shines a spotlight on their biggest problem.
Capacity.
They admitted 2026 volume growth is currently tight. The North American business is going to run at something like 99% asset utilization next year.
99%. I mean, that's basically redlining the engine 24/7. There's no room for error, no room for new business.
Yeah.
It just puts a cap on their growth.
It's a hard cap. And that's exactly why the new plant in Millersburg, Oregon is so critical. It's the whole story.
That one's on schedule for the second half of 2026, right?
It is. And this isn't just about more cans. This is an inflection point for the whole business.
So how significant is it, really?
It's expected to unlock 1.5 billion units of volume by 2027. That's a 3% lift on its own. But more importantly, it makes their whole supply chain more efficient.
It gives them breathing room.
Exactly. And management was very direct. They said this should lead to a return to record canned profitability in 2027. That timing from constraint to freedom, that defines the whole investment case.
Okay, so what does this mean for capital allocation going forward?
Well, capital spending, or CapEx, is going to normalize. It'll be back in line with or slightly above D&A in 2026 after a couple of years below that level.
And the buybacks. Are they going to keep up that aggressive pace?
They'll likely moderate a bit. I mean, they've bought back over $3 billion in stock over the last 2 years. The pace will slow, but they're still committed to returning value.
All right, let's shift gears. This is the part of the show where we try to connect the dots, the not financial advice segment.
My favorite part.
So you have this situation, a tight 2026 where they're running at 99% utilization and margins are capped, and then this big capacity-led growth story for 2027. Feels like the market might be overlooking that 2027 story because of the 2026 bottleneck.
That's the whole thesis. Management themselves basically said the stock is very cheap if you look at their 5-year plan. That 2026 tightness creates a temporary air pocket.
Opportunity.
An opportunity. So this is a multi-year setup betting on their execution.
So what's the outrageously plausible trade idea?
The idea would be to implement a long-dated bull call spread, specifically targeting the January 2027 expiration.
Okay, walk us through that for people who aren't deep into options.
Sure. So a bull call spread means you're buying a call option at one price, and at the same time, you're selling another call option at a higher price. They both expire on the same date.
And the benefit is what?
The main benefit is it dramatically lowers your cost and it limits your maximum loss. You're capping your potential upside, sure, but you're also putting way less capital at risk to make the bet.
And why January 2027? The timing is everything here.
The timing is everything. The Millersburg plant comes online in late 2026. By January 2027, the earnings report should be showing clear proof of that volume unlock, the 1.5 billion extra cans, and the higher profit per can that comes with it.
So you're basically using the options to skip over all the noise of 2026 and bet directly on that 2027 inflection point.
That's it, exactly. It's a pure bet that management can execute on that plan and hit that rendered can profitability goal they've set out.
Okay, let's do a quick recap of the deep dive. Ball is executing a very deliberate, focused strategy. It's all about the global beverage can business now.
And that's supported by strong volume and really disciplined capital returns. The narrative has shifted from, reshaping the company to just pure operational compounding.
The key takeaway for you, the listener, is all about execution. You have to watch the timing and the ramp up of that Millersburg facility like a hawk.
Absolutely. It is the single biggest internal catalyst they have. Any delays there would fundamentally change the story.
And we'll leave you with one final provocative thought. Management seemed very confident that because consumers are focusing their spending on food and beverage, Ball is in a really defensive position.
Right. They're not competing with vacations or home renovations for the consumer's dollar anymore.
So the question is, does this shift in consumer spending prioritizing these everyday items actually solidify the aluminum can industry's moat for the next whole economic cycle, no matter what happens with the broader economy?
That is something for you to think about.
As always, remember, we are here to provide insight and analysis. We are not financial advisors. Any discussion of trades is for informational purposes only.
You have to do your own research before making any investment decisions.
Thank you for joining us for this deep dive. We'll be back next time with more critical insights from the earnings circuit.